I just made $31,000 by trading the S&P 500 by doing one simple thing, which is buying option calls, because the market's just simply going up. And it has been going up for the past 20 years or so. You know the craziest part about it? I don't even need the money. I already 100% debt free. I've already bought my parents' cars that were 100% in cash. I already traveled all the places I've wanted to travel to. I've already bought $100,000+ of jewelry. There's nothing else to do. I'm over here bored training to run a marathon just because. But you want to know the sad thing about all of it? You could have made the exact same money and you probably need it way more than I do right now. But here's the thing. You knew the stock market was going to go up once a new president was elected. Or maybe that's a big assumption. Maybe you just didn't do what I exactly did, which was I went to Google, I typed in, how does the stock market perform after a new president is elected? And then it gave me the data that said 8 out of 10 times the market goes up on the first couple of days. So I said, sounds like guaranteed simple money. Then I said, I don't want to just believe Google. I'll go to Thinkorswim, which is the trading platform, look at all the years when it actually happened in the past. Let's see if it's true. And you know what was crazy? Google didn't lie. So I went in, took the calls, the market went up, and I made $30K from basically a single Google search. In other words though, you were one Google search away from making $30,000, but you did nothing. But that's fine. Let me just take a step back and let's just talk about why most people fail at trading in general first. We'll do some math, we'll kind of walk through things, and etc. The main reason why is what I call the illusion of the stock market. So in the stock market, you have two options of what you can basically do from a fundamental perspective. There's a left side, which you can make money when the market goes up, which is called option calls. And then there's a right side. You can make money when the market goes down, which is called option puts or shorting if you're familiar with that. Now the goal with trading, of course, fundamentally, is you want to be right and win more than actually lose your trades and lose more money, of course, right? But technically, as everyone knows, in the past 20 years for the S&P 500, all it's done is basically go up. So you start to kind of question yourself, if the market basically only goes up long term, why would you even try to be right about when the market goes down? That doesn't even make any sense if it goes up over time, up. Think about it mathematically. If the market goes up statistically 60% of the time on an annualized basis, and it goes down 40% of the time on an annual basis, why not just only do the 60% and not do the 40% in the first place? A, it's less effort, and B, it's the path of least resistance because you can do and win more by just doing the one-sided thing since it happens more often anyway. Probability perspective, right? Because why would you add something to your formula that has a lower probability of winning if your ultimate goal is winning more money? Wouldn't you just do the simplistic thing? But that's FY, the stat, if you do just option calls on one thing like the S&P 500, such as SPY. Well, think about what most people do. They'll trade maybe the S&P 500, but they'll also trade Tesla. They'll also trade Amazon. They'll also trade 15 other things. That 40% is multiplied so much greater because you're doing calls and puts on multiple different things, even though most things go up. But most things go up when they're in the S&P 500 because things fall out of the S&P 500 when they don't perform as well. By default, everything goes up in the S&P 500. So it's the de facto type of ETF that you want to trade. You can trade individual stocks, but those aren't guaranteed to last for 20 plus years, let alone guaranteed to last to go up constantly. So again, why would you why would you increase the 40% of failing to an 80%? No wonder people fail. They don't get in something that's proven to work, and they don't get in something that's proven just long term to actually to not essentially fall. Doesn't make any sense. But fine, I'll play devil's advocate. Sure, if you trade a whole bunch of different tickers, stocks, option calls, option puts, different types of strategies all over the place, you could technically have more variety, which could increase how much money you make. But technically speaking, which one would you rather have? Would you rather have more trade opportunities and more risk, but potentially more money? Or would you rather have a good amount of money, low risk, and easier trades because there's not that many trades to do? Maybe I'm crazy, but the latter sounds much, much, much more interesting because the point of trading is to make money. Not on the left-hand side, or your right-hand side, excuse me, for you to just have fun doing all these different stock trades and learn all this cool stuff. I'm not here to have fun, especially when I was starting. I would imagine you were probably similar thinking when I was starting, which is I'm here to make money, not to smile when I'm buying stuff on the S&P 500 and Tesla and go talk to my friends about you should check out Amazon, it's running up. I don't care. I want to get in, make money, leave. Make as few trades as possible, leave. Go do the stuff like do a marathon and leave. I don't want to do all this extra work. Maybe you like working. Maybe I'm crazy. I don't like working. Why else do you think I do trading? Again, maybe I'm the crazy one. Let me know. So I know this is nothing new because when you start thinking about it, you're like, all the experts have all said the same thing, but in a different way, just tweaked a little bit. They all said, don't time the market or only buy the dip. They never said short the top. They never said just time the market. All those other, the opposite, the inverse of everything I just said is not just buying option calls in the S&P 500. It's buy calls when it goes up, and when it hits a certain area, cool, buy puts, it'll go down, and you're timing it. Or hey, I know there was a dip that happened, but I'm gonna wait for that dip because it might keep dipping and I'll time it the perfect way and then I'll make money when it goes up and I'll have a bigger margin. No, you're overthinking it. It's down, you buy calls. It's up, you sell when there's a pullback and you're done. Now I know what you're thinking though. Maurice, if it was that easy, every single person watching this video or trading the stock market, they'd all be rich. You just said all the people have given the secrets away. All the people have told you exactly what to do. But everyone's not rich. They're all still failing. So it can't be that simple. I got you. I mentioned this earlier, but it realistically, A, is that simple. But B, unfortunately, people lose because they get fancy. They think it's cool to buy Tesla and try to hold it long term. And not that Tesla's going anywhere. I have 2 Teslas myself paid off in cash. But that's not something you're like, okay, I'm gonna hold it for 40 years. I'm only gonna do option calls that go up every single day, to go up every single week, etc., etc. That's not something you necessarily trade off of. You can if you want, perfectly fine. But that's not something that's reliable. That's not something that has 20 years of history. That's not something that you'd base everything about your future off of. And to go the other side with, say, Amazon. The other people get fancy even with stuff like Amazon. They'll say, you know what I'm gonna do? I like Amazon, but from the look of it, I'm gonna short Amazon because it's kind of overvalued, personally, I believe. And because of that, I'm gonna make money when it starts crashing because too many people use it and they're not going into retail stores. And I think retail stores are gonna come back. No, first of all, no one cares about your opinion. Second of all, your opinion is not based off of factual evidence from the past 20 years. Third of all, who cares what you think? I'm, again, here to make money. What has the S&P 500 done for the past 20 years? It's gone up. So, at the moment, it's the best thing to potentially trade based off from a simplistic logic of the higher your win rate, the more money you win. That's it. But if you don't believe me, that's fine. You can do the cool, fun trades that you like doing. I'll stick to the boring, yawn-filled trades that I have done for the past 6 years that have ended up making me 100% debt-free, do all the things I've ever wanted to do my entire life, and never have to work for another person my entire life ever again. You can do the cool stuff. I'll do the boring stuff that generates about a crap load of money. So if you haven't gotten the message yet, buy option calls. I don't gain anything from this at all. I've already done the things I wanted to do. I'm just trying to help a few people out that actually will listen to this message. And now the next step is up to you. Figure out where to do the buying for those option calls. Figure out what strike to buy, price to buy it at. Figure out the strategy behind that, because of course we're not just going to blindly buy things. And if you figure out just those 3 components, then everything's going to be yours that you've ever wanted it to be.